Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now, Kim Dawson, New Edge Wealth, who, people make jokes about it, but they're strategists that have a conviction to stay in the market. Kim Dawson, I think the bears percolated this weekend off the calendar and said, OMG, now's the time to get out. Why are you still in the market?
Because the trend is still up, momentum is positive, and liquidity is supportive. I think that we are very attuned to the brewing risks, meaning that for the first time in 12 months, you saw GDP forecasts get cut on Friday. That's significant.
I was on the beach.
So for the last 18 months, we've been seeing a rising growth forecast environment, which has been really good for risk assets. It's allowed valuations to continue to expand, EPS estimates to continue to drift higher. If that starts to change in a more meaningful way, then we would grow more cautious. But really, it's a matter of balancing the fact that you still have this positive trend with some of these brewing risks.
Torsten Slok was out with a good note in the last couple of days, our good friend over at Apollo. The top 10 companies in the S&P 500 make up 35% of the market cap, but only 23% of the earnings. Talking about that concentration risk in the market. How much of a risk is that for you if an NVIDIA or somebody else really disappoints somewhere along the line?
One of the phrases that we keep repeating is that trees can grow a lot longer than you think, but they usually stop short of the sky. Okay. Meaning that eventually you're going to have a challenge where you will have priced all of these unending growth parts of the market at such lofty valuations that even if they deliver growth, you will see an unwind in the valuation. The problem is you need a catalyst, and you need earnings to stop going up.
What's important here, folks, is Kim Dawson brings bulletproof mathematics to this. She's not just spouting paragraphs. Do you have a discounted cash flow model or some form of net present value study that allows you to stay in the market? How do you get there?
I will say that we are in very rarefied air for valuations. And so if you're just looking at fundamentals, what you have to acknowledge is that you're back up to 2020, 2021 levels of valuations. So if you do a DCF, you would argue that fundamentally we are overvalued.
Do you slam your terminal value more present and put extra weight on quarterly and annual free cash flow assumptions? That seems to be the rationalization.
Yeah, look, every time you try to say this time is different, that's usually when you run headfirst into a market peak. Go back to December of 2021. Robert Shiller came out and said, don't worry about high valuations because interest rates are so low. We ended up being in a bubble for both equities and for bonds, and thus 22 was a bad year. I think that discipline about valuation needs to be very, very present, which just means we're not chasing growth stocks at this time. And if we're looking within the growth index, we're looking at names that are trading at a discount to the index.
Where do I go here? I'm afraid of tech stocks. Do I go financials, energy, industrials? Where does a normal person go?
Yeah, I think that there are plenty of opportunities outside of the mega cap stocks, but you have to be highly selective, which means that we don't think that you should be indexing your value, your international or your small cap, meaning active management is absolutely imperative because there's a big divergence between the winners and the losers in that space. And so if you can look at names with high free cash flow, strong return on invested capital, good growing dividends, all the things that we love as long-term investors, you weed out the strength from the weakness, and that's where you can add value.
In the textbook will say out of 100 stocks, 30 have strength, 70 have weakness. How do you find the 70% you don't want to own?
Yeah, well, it's a combination of the fundamentals and then that discipline around the technicals, which is that what we do is we screen out names that do have high debt, meaning that they rely on capital markets just to keep the lights on. We screen out names that have really volatile free cash flow generation. We want stability in that. And then what we're trying to identify is those names that have high ROICs, return on invested capital. Every dollar they put into the business, they generate more out. That doesn't mean you get the stocks right at every moment, because a lot of those names are still being left behind in this extraordinarily narrow market.
What we reminded, I guess, Thursday night into Friday is this is an election year, and there's election political risk in the marketplace. When you talk to your clients, how do you talk to them about what could be a volatile time on the political front over the next 6 months?
I think we have to first identify what neither party is talking about, which is balanced budgets and austerity. So no matter what party you affiliate with, you have to acknowledge that both parties are going to probably contribute to higher deficits, which just means that the bond market is going to have to continue to digest this higher issuance of treasuries. That could mean a steeper yield curve through a bear steepening, and it could mean this continued drift higher in the long end of the curve.
Let me double barrel use of cash here. It's real simple. Use of cash, share buyback, dividend growth, and I'd compound with that the nascent idea that big tech and other companies, frankly, will issue more bonds. Am I onto something there?
They don't. Do they need to? I think
they don't need to. That's precisely the point. But you do it and you retire stock. I mean, that's the it's Mario Gabelli 101.
Yeah. I think that the calculus for using debt in order to do share repurchases is less attractive at today's rates. But to your point, credit spreads are also extraordinarily tight. So you could take advantage of, say, yes, my base yield is higher, but nobody really is demanding extra compensation for credit risk. The triple B to double B spread is actually tighter today than it was in 2021. Showing just how price perfection the credit market is.
I mean, right there, I think, Paul, that's the quote of the day here, is the bond market is telling the equity market what to do. The most important thing that happened last quarter was at Home Depot. Yeah. They had a bond offering. It was like 4 phone calls.
Yeah. Monster
I mean, to
deal.
me, that's the most important thing last quarter.
What are you guys thinking about our Federal Reserve here this year? When, how many times? What are you guys factoring in?
I think that the Fed is far more balanced, and this is their words, we're more balanced in the risks between unemployment going up and inflation going up, meaning that they are growing more concerned about some of this fraying in the labor market. We are already at their 4.0% target for unemployment this year, which just means that if we creep higher into that 4.2 zone, it could be the room for them to be able to cut.
We got to rip up the script here now.
Why not?
I mean, YouTube's on fire. There's a woman or guy here, I don't know which, and their daughter's watching you right now, and the daughter wants to be you. How did you get into the academics of finance? How did you get so damn smart down in Florida?
Down in Florida, the caveat. Look, I think read a lot of books, be a voracious reader, and I think that the study of economics is the most beautiful study in a liberal arts education. You get math, sociology.
I just told my 19-year-old that yesterday.
What's the number one investment book that changed your life? I know mine, but what was the one where you said, hey, this is interesting? Yeah, no, not Flying on One Engine. What was the book? What was the book that, you're 17, 18 years old, and it was an investment book?
Yeah, I think More Money Than God is a fantastic book, Sebastian Mallaby, about some of the great hedge fund investors. I think that books like Austerity, which is a fantastic book about politics and economics coming out of the European
For me, it was
crisis.
Against the Gods, Peter Bernstein, on risk and uncertainty.
Wealth, War, and Wisdom, Barton Biggs.
Yeah.
Absolutely fascinating, talking about seeing through volatility, essential reads.
We're going to rip up the script. We're going to put this on Single Best Idea today with Cam Dawson here. This is how you do it, folks. You got to get kids interested in this. You throw the book at them and say, no TikTok till you read the book that Cam Dawson says to read. Right now, we're going to migrate to the bond market and gauge here the coupon. Sonal Desai joins us. right now with Franklin Templeton. Chanel, are you managing for coupon, or can you actually give me total return?
So, this year, I think total return, and maybe for a while, total return is not looking fabulous. It is for coupon. I think we're getting to a stage where if you're just looking at high quality bonds, spreads have really come in so much in all the spread sectors. And if I actually see them as being pretty fair where they are.
Yeah.
I've been calling for 425 to 475 most of this year, and I have no reason to really alter that very much.
Kathy Jones with us earlier with Schwab, and she just puts out on Twitter an amazing chart, and this is something I don't look at, Paul, but it's basically 10 or 15 bond categories, bank loans, all the stuff Franklin Templeton does. Paul, I would have done better in cash.
Cash, I know.
That's the challenge.
Exactly. All right, so in honor of Joe Mysak, who is enjoying his first day of retirement today, the Dean of Municipal Reporters out there, talk to me about the municipal bond market. I think I can get some really attractive tax equivalent yields out there. How do you view the municipal bond market?
We do like it. We like the municipal market. We think technicals are favorable. It was very out of favor for most of last year, enormously so. And this year it is coming back, and it is one of the areas which we like. We think actually, to go back to what you and Tom were just saying, you could have done better in cash. This is true, yeah, but you can't stay in cash. That's the risk, because you've got to start dipping your feet back into the bond market. My advice would be at least go ultra short before you take the deep dive, because when the time comes, you won't always have the yields which you currently have. Now, total return is something we've gotten very used to over the last 20 years of easy money and liquidity, but I don't think that's not where the bond market necessarily is going to take us over the next several years. It's going to do what it says on the can. It's going to deliver a certain amount of income, ideally with less volatility than we're seeing right now, as markets adjust to what I think is the new state. The new state, which is a lot like the old state, which was from the 1950s until the global financial crisis. But, bonds delivered decent returns, but not equity-like returns.
I'm looking at the Bloomberg U.S. Corporate High Yield Total Return Index, positive 2.58% year to date. High yield. Give us your thoughts there.
So high yield, here's the thing with high yield. I think, if you manage it actively, so not buying the index, high yield can actually deliver a decent return. But once again, what you're really looking at is the overall yield that you're getting from it. And what you're getting in total from high yield bonds right now is between 7 and 8%, which relative to what you've gotten over the last couple of decades is really not terrible. However, in spread terms, we definitely are tight, which means that the cushion against things like defaults is not very high. Therefore, talking my book a little bit here, you have to be active. You can't just jump in there and buy these indices, because there's very, very little cushion against defaults. I'm not anticipating a massive slowdown, which would really, get us going towards a space of high level defaults. We actually think corporate health is pretty solid right now, but I would not want to buy any indices, whether it's bank loans or high yield or investment grade at this point.
Chanel Desai, thank you so much. Joining us now, Leslie Vinjamuri, Chatham House, on all that's going on in Washington. Frankly, she saw this coming, which helps out. Leslie, not so much now what, but have we forgotten that we're supposed to have contested elections? We had the Bush royalty, the Obama royalty maybe, the Clinton royalty times 2, I guess. Have we forgotten that it's okay to have a Donnybrook to the convention?
Yeah, I think we've gotten very risk averse. American politics is tough. It's expensive. The electoral system sets a very high bar. Name recognition is everything. So, you might be cynical about the American people. I'm not. But I do think the system and the institutions make it make people very risk averse, people at the top of the party structures.
All the money that's being involved, Mr. Katzenberg, I guess, driving the donor component of this debate in the last 72 hours. And I get the idea the money can go to the vice president. Can these other candidates, if we get to that, can they run to the convention in 8 weeks, I believe it is, with less money? Or can they not run because they don't have a gajillion dollars?
You know, as we all know, the first thing that has to be decided is by President Biden, whether he's going to run. If he decides not to run, then of course the entire field opens up in a way that, we don't have a good roadmap for, because it's not the normal scenario. But could donors get behind a new candidate? Yes, of course they could. And this is the conversation that everybody is having pretty much around the clock since the debate. But so far, what we know, and I suspect we know a lot less than what's actually transpiring, is that the Biden team are locking in. But watch this space. One more very significant stumble by President Biden, that would be difficult to recover. And the very bad scenario is that happens far too late to make a change. There are a lot of people now that think that the vote for Donald Trump is just going to be much stronger, that people will stay home, that we're sort of on the fence and thinking about maybe voting for President Biden. This is a very risky period. And come September, when politics and students and America is sort of back from the summer, it's going to be a very difficult campaign season, a very difficult politics. We're a little bit on hiatus through July and August, even with the conventions.
Leslie, Matt from the fifth floor writes in and just asked, was Thursday night just a bad night, or is it something more? If it's something more, what role does the Democratic, Party have in kind of suggesting where we go from here? Or is it entirely up to President Biden?
Look, I have two answers to that. One is that, can President Biden govern for 4 more years? Absolutely. He has an extraordinary team of people around him in pretty much every single issue that matters. He doesn't have to work 12-hour days. He can make decisions, but let other people really do the daily work and the hard work of governing. The bigger question, though, is can he get elected? And, was it a blip? It doesn't really matter if it was a blip. The American people, the world watched the so-called blip. They will make their own decisions about whether it was a blip. And undoubtedly, it is going to unsettle the confidence of very many people that were already concerned.
A couple times this weekend, the phrase smoke-filled rooms came up. I mean, I'm old enough to remember 68 quite clearly. I guess we're going to redux that in Chicago. Define the smoke-filled rooms, Leslie Vinger-Murray, of 2024.
No, you're going to have to define the smoke-filled rooms, Tom. I mean, I think it's just not being able to see through clearly to what's coming next. On the 68, everybody wants to go back to 1968. Sure, there are some really significant lessons and parallels there, but history is, history, what doesn't repeat itself, it does rhyme.
Yeah, I don't mean to interrupt, Leslie, but I think this is really important. I'm sorry, but is there no more smoke-filled rooms because there's a monopoly of a family that runs a given party? I don't want to get Democrat, Republican here, but there used to be a conversation nationally with cigars in hand among a party. Is that like a fiction now where it's just run by, the critics would say, the president and the first lady?
No, I suspect, and again, Tom, this is where we don't know everything we'd like to know. We know what the New York Times has said. We know what the Wall Street Journal has said. We know what the FT and the Economist have said. At the end of the day, those conversations are happening. Of course they're happening. They're happening out of sight and certainly out of hearing distance. And this is why, everybody over the weekend who's talking is saying that the Biden team is locking down, that they're going to keep President Biden on the ticket. And maybe that's the case, but they're certainly not going to say, well, we're not sure. Imagine the volatility, uncertainty at a time of two major wars, a China threat, a whole amount of global disarray, dysfunction, polarization. You don't send the signal until or unless you've made a decision, there we will hear nothing from the top unless they
Right.
make that decision.
Leslie, what's going to happen at this convention? It seems like Tom and I need to pay attention to this convention coming up.
I think we all need to pay attention to this convention. We can imagine a couple of different scenarios. We can imagine that it just sort of you're talking obviously about August and not about July. In my view, it's a shame they're not reversed in terms of the timing, but August, it could just go as planned, or we might be in a situation where we are looking at Josh Shapiro, Gretchen Whitmer, Gavin Newsom, a number of candidates whose names are out and about. Kamala Harris, obviously, perhaps just staying as a vice president with somebody else on top. There are all sorts of scenarios and conversations going on, but that, again, we know depends on the decision that ultimately
Right.
President Biden will have to make.
We got to go. Dr. Vinjamuri, thank you so much. I'm a little congested, Lisa. Please start.
Very good transition. I like that. We were just talking about New Jersey Transit raising prices. My goodness, let's make this transition. So congestion pricing in New York, it could be getting a new life, but it could be, okay, so state lawmakers, the New York Times says they've been privately, this informal campaign to persuade Governor Hochul to move ahead with the tolls, but make them less expensive. So below the $15. They say they won't mind adjusting that toll, other features of the plan, because approving additional revenue could make up for the shortfall to the MTA, but only if this program is allowed to move forward. So if it moves forward, they said, well, let's try and bring the price down a little bit. I mean, in London, we talked about this, London had an initial fee that was half the $15 charge that's being proposed to vehicles in New York City. So they're saying, hey, if London, brought it out at a cheaper price,
well, they've already installed all the monitors all around Manhattan. I mean, I don't know what that costs, but here on Lexington Avenue and 60th Street, you can see them right there.
They're right there.
They're huge. They're not, they're
so they're
serious
saying, let's put them to use,
yes, okay,
but just at a lower price.
All right, we'll
don't know how that will
we'll roll that by John Tucker at some point and see what he thinks.
No, I don't know where this goes other than when I read about the projects, they're mostly projects we need. They're not like silly add-ons. They're like, okay, we're 20 million plus people. We need this, and now we can't do this.
Yep.
And there's people that are saying, no fees, like they're like Sweeney in the New Jersey Transit thing. But to me, it's just $15.
Yeah, that's
You got to pop down to the New Era baseball cap store at Times Square to keep the little one happy. $15 to go down and get a stupid baseball cap add-on. That's how I look at this.
Yeah, I'm not sure what the price point is, but hopefully they can come up with one.
Next.
All right. New York Post is pointing to more evidence. Workers in New York City are coming back to the office. You guys haven't seen this shit. You're not buying it? This is according to the Real Estate Board of New York. Manhattan office visitations, that's what they're saying in May, were about 74% of 2019
Am I visiting today or
levels.
am I working today? Am I visiting?
Are you visiting or are you working?
Okay.
So they base it on visits, right, to about 350 office buildings. They base it on cell phone records, but also the retail traffic in those buildings, too. So they're trying to show that more people, workers.
But we're still like
coming back.
75% of pre-pandemic or something, right? Or
74%, of pre-pandemic levels.
Do you believe it, Lisa?
I'm starting to see more people coming to the office. When I'm talking with friends, they're like, yeah, we're back like 3 days now instead of fully from home.
I have to be so careful here, folks. Rich, can you get the surveillance cork out and put it in my mouth right now to save my employment?
But look at the flow of people.
I look at
now.
Lexington Avenue.
Today's a Monday. We're
no
coming in. It's 8 o'clock.
I look at Lexington Avenue, and here's the way I look at it, folks. You're 20-something years old. You got a bunch of fancy degrees. You're lucky to work at 100XX, and you're not in on Friday when you can get 20 minutes or 40 minutes with somebody 25 years older with you to pontificate about wisdom.
Yeah,
that to me, that's missing, Paul.
I agree, but I think the hybrid thing is here to stay, and that might be something that the workforce can
Get
evolve
that
to.
cork. Come on, Bob, get the cork now. Next, save me.
Next. How much would you need to make to feel financially secure? This is a question that's being put out there. There's a study from Bankrate that says, on average, Americans think they would need to make $186,000 just to feel comfortable. But if you think about it, according to Census Bureau data, it's more than 2 times what the average full-time year-round worker made in 2022. So just 30% said that they are likely to even earn that much. So people are feeling like they're not financially secure. That's up from like 72% in 2023. Older Americans, baby boomers, Gen Xers, they're more likely to feel that way. And if they want to feel financially rich, they have to make $520,000. That's what they're saying that they feel
This
like.
came up not once but twice this week, and I'm sure all of you had the same thing, all of you listening across this nation. It's simple. The system's broken. End of discussion. There's no other way to put it.
And I think inflation, these higher in prices that everybody's paying for a lot of goods and services, that's making you feel probably less secure.
Right.
Because, I mean, you just, whatever dollar you are making is not buying as much as it did 4, 5, 6 years ago. So that inflation shock that we've all dealt with is still there. And I think it's top of mind for everybody. You go to Costco, you go to a restaurant, you go anywhere. So.
I mean, quickly here, I mean, you got to have a tough mother like Lisa Mateo.
Yeah.
I mean, that's really the first order condition, because a lot of these kids are just not working like we worked. I mean, we thought nothing of working 70 hours a week, 80 hours a week. It was just 7 days a week. It was understood.
Yep.
Next.
Time's changing.
Well.
You know what's also changing? How much money goes into your 401k. Yes, new hires, putting more money into it. But it's not actually their choice in some reasons, because the 6% saving, that's what they're putting into. It's a new standard for nearly a third of companies. They use automatic 401k enrollment. So companies are automatically rolling into that 6%.
Whoa. So you don't opt in? They just take it?
Automatic.
Opt in.
Really?
Yes.
Major shout out, Peter Orszag, right in the shop now at Lazard. Peter Orszag at Brookings years ago led the charge in this. I can't convey how lone a voice he was on opt-in. And Peter Orszag, coming out of LSE with all of his great academics, said this is the only way we're going to get it solved. My only problem with that is it's 6%.
Correct.
And not more. And I don't know how we get there. I'll let senior management in any given firm figure that out. But Orszag drove the boat on this.
Yeah, but a lot more companies, 60% of companies.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.